Hello, welcome to MyForex Eye web series. The topic for discussion is about the different banking products which are available to the exporter to minimize their treasury operations. Now, exporters are exposed to foreign currency risk when they receive a foreign currency against their sales. So what does Forex risk entail? Let's look at that. Forex risk which comes with any change in the foreign exchange rate. Since the FX market are open 24/7, the volatility is very high, making it difficult to predict the cash flows of an exporter. We understand that the exporter receives the foreign currency and would be under risk when the foreign currency starts to fall against the home currency. This is because he would have kept a base exchange rate in mind while quoting his price to the buyer, and that is his benchmark. Now, if the foreign currency falls more than the benchmark, then his risk increases and he converts the foreign currency at a lower rate than benchmarked. It is vice versa for an importer. Now, which are the different bank products which are there to optimize the exporter's treasury? The banks have evolved over the years and now offer many treasury products to their clients in this competitive banking industry. The exporter looks to optimize the products depending on their requirement. There are several products which are outlined here. Let's understand them briefly. Forwards, futures, options, export LC discounting, export factoring, packing credit, foreign currency term loan, and swaps. The first basic derivative is the forward, which the bank offers to their client. It is executed over the counter and is binding and obligatory, as once entered into has to be honored. The flexibility of the customizing, that is the date and the amount, are required, makes them popular when compared with other derivative products. For an exporter, it is an agreement to sell the underlying foreign currency at a specified future date, that is a maturity, at an agreed price today. The price is fixed today, and then irrespective of the value of the currency on the maturity date, the foreign currency has to be sold at the price already fixed earlier. So forward rate is nothing but the spot rate plus the forward premium. Now this exporter receives the premium, which is because of the interest rate arbitrage between the two currencies, and then that gets added to the spot rate. So an exporter takes forward contracts to sell foreign currency, and therefore he receives the forward premium. The next product is the futures. It is a popular derivative instrument whereby they are standardized and clearly defined. They are regulated as they are executed through an exchange. NSE provides a platform to corporates and retail clients to trade in currency futures. A margin has to be deposited with the exchange before entering into the contract. Major currencies like US dollar, UK pound, the euro, or the Japanese yen, all of these futures are traded in the Indian market. The flexibility in terms of quantity is fixed in lots. A lot comprises of 1,000 units. So, when a margin is to be submitted with the exchange to transact, only thereby they can start trading in the account. The exporter will sell futures contract of an underlying foreign currency to hedge his forex risk. Now, what is the difference between forwards and futures? They seem quite similar. But the following have to be kept in mind to understand what keeps them distinct. While the forwards are customized contracts, futures are standard product. Forwards are traded over the counter with the bank, whereas futures are traded in exchanges like the NSE or the BSE. Forwards are utilized for receivables and payables and can also be cash settles, whereas in futures it is only cash settlement. Opaque forex rates. Now forwards do not give a clear, transparent picture of what the foreign exchange rates are prevailing in the market, whereas in futures, because they are quoted in the exchange, they are quite transparent. And because of which you have high transaction costs for the non-transparency in the forex rate, whereas in futures it's a fixed transaction cost which you know beforehand. The third product is the options. Now the options give the right to buy or sell an underlying asset at a specified price on or till a specified date. Now the specified price is nothing but the strike price, and the specified date is the expiry date. There are two types of options, call option or the put option. In the call option, the buyer has the right to buy, whereas in the put option, he has a right to sell. The options can be of two types, the European option or the American option. The European option can be exercised only on the maturity date, while an American option can be exercised on any business day up to the maturity date, including the maturity date also. To acquire this right, the buyer pays to the seller of an option a fee which is called the option premium or the option price. Now this price is paid upfront at the time of buying the option. The option buyer, has the choice to exercise or not to exercise this right. So if an exporter decided to buy an option, he has to pay an option premium upfront. Now let's take an example to understand this better. Now in this example, the option used is the USD INR put option. The outlook is bearish on the dollar and the risk is certainly of the rupee appreciation. So the solution that we have is we buy a put option at the strike price which is equal to the forward rate. Now this price which is equal to the forward rate is called the at the money option. Now in the example, let's assume that the spot is 74 with forward rate of 6 months at 75.5, which basically means that the forward premium of 1.5 rupees is there. Then he buys a put option at 75.5, which is the forward rate, because it's an at the money option. The option premium which is to be paid upfront is 1.2 rupees. On maturity, if the rupee appreciates below 74, then the exporter exercises the option and receives 75.5. But if on maturity the rupee depreciates above 75.5, then the exporter chooses not to exercise the option and receives at the current market rate. Now this is basically a safety net which the exporter has by paying an upfront premium, just like in the life insurance. The other product is the export LC discounting. Now export LC discounting is nothing but whereby the exporters can discount the bill and receive their payment using a usance letter of credit. This discounting is done on a post-acceptance basis. It's pre-decided. The financier needs to have some credit appetite on the LC issuing bank. Funds are made available to exporters' bank via the banking channels. To understand this better, let's go through the process flow. So the first step which happens is that the exporter enters into a contract with the buyer, after which the banks in India are approached by the exporter for an indicative pricing. Now, the buyer's bank transmits the LC to exporter's bank, which is through the domestic financing bank, which provides a copy of the same to the supplier. Now, the exporter, after this, ships the goods and submits the documents at the domestic financing bank counter. The domestic financing bank checks the documents and sends the documents to the buyer's bank for acceptance. The buyer's bank provides acceptance to domestic financing bank, guaranteeing the payment on the due date. Now the domestic financing bank discounts the bill, makes net payment to the exporter after deduction of the discount. On maturity, the buyer's bank makes the payment to the domestic financing bank, thereby completing the discounting cycle. The other product is the export factoring. Now in export factoring, it is a form of financial transaction in which a company buys a debt or invoice from another company. The process is quite simple. Let's take a look at it. The seller, he sells the goods and raises an invoice to the buyer. The second step involves the seller sending the invoice for funding to the factor. Mind you, the factor assumes all the risks of the buyer and makes sure that the seller receives the payment. The third step is when the factor, upon receiving the invoice, pays up to 90% of the invoice value to the seller. Now, the buyer makes the invoice payment. Once this is done, the factor will make the balance payment, the remaining 10% of the remaining amount, after deducting the factoring fees or the commission. So this way, the buyer gets time to make the payment. At the same time, the seller is happy that his payment has come, at least 90% of it has come at the right time. How do you differentiate between export LC discounting and export factoring? Now, bill discounting includes only those trade debts which are supported by the account receivables, whereas in factoring, this includes the entire trade debts of a client. The entire bill is discounted and paid for when the transaction takes place under discounting. But under factoring, a factor gives maximum part of the amount as advance when the transaction takes place and the remaining amount at the time of settlement after deducting the commission. Only the option of recourse is available for discounting, whereas factoring has both recourse and non-recourse options available at their end. Another important and often used is the export packing credit. Now, the packing credit is basically a pre-shipment credit which is taken for working capital requirements by an exporter so that he can procure the goods, to finance the goods procurement. It is available in foreign currencies, the major ones, the dollar, pound, euro and the yen, as well as in the Indian rupee. Now, packing credit in foreign currency, PCFC, is the finance at internationally competitive interest rates, whereas the rate of interest is linked to the LIBOR rate. The choice of currencies, as mentioned earlier, is dollar, pound, euro, yen, etc. The period is based on the export trade cycle, usually up to 6 months, that is 180 days. That is about the foreign currency. Now let's look at the packing credit in Indian rupee. Credit is availed in rupee. Future receivable is still due in foreign currency, right? Because once the goods are shipped, only then the payment will come in the foreign currency. Denominated in higher interest rates, given that INR interest rates are much higher. This allows exporters to start hedging and receive a premium on the hedge position. Now, trying to compare between the three, we look at this. We have packing credit in foreign currency versus Indian rupee. When you're trying to take a packing credit in Indian rupee, there are two options there. One is when you are an MSME. The other is when you're a non-MSME. Now, the government of India has come out with this interest subvention, which gives a little edge to the MSMEs over the other, corporates. Trying to understand in detail, the organization type in PCFC, irrespective of whether it is an MSME or non-MSME, the 6 months LIBOR of 0.25% is applied. The spread ranges from 2 to 2.5%. There is no other subvention given for a PCFC, and the total cost comes to about 2.25 to 2.75%. Now let's look at the export packing credit in rupee terms for an MSME. An MSME receives has to pay 8 to 9% of interest. The interest subvention given by the Government of India is at 5%. And when he chooses to hedge that particular position, he gets a forward premium of 4%. The net rate which comes is almost zero or almost zero. Now, when it is a non-MSME, which basically means that the interest applied is 7.5 to 8.5%, and the interest subvention is lower at 3%. The forward premium is the same as 4%, so the net rate which will be applied for the exposure will be a 1.5%. Now, when I compare these three, very often, earlier before the subvention was introduced, the PCFC was preferred. But given the current circumstances and the offer by the government, we have a rupee terms for an MSME much more suitable and beneficial, where they're not paying any costing for this particular transaction, whereas the non-MSME also has a reduced cost of 1.5%. The foreign currency term loan. The basic features of this is it is long-term in nature. It is available in the four currencies, the dollar, pound, euro and the yen. The interest rate is set as per the applicable LIBOR rates. They're basically used for import of capital products. Repayment of the current rupee term loan, it can also be used for that. And a repayment of an existing ECB, the external commercial borrowings. Now, why would someone choose an FCTL? Because of the low interest rates. The spread over the interest rates are often linked to the credit score of the borrower. And the repayment of the high cost rupee loan using the low cost FCTL. So these are the advantages of the foreign currency term loan. But the risk is certainly of the exchange rate fluctuation, which, well, we know how to manage it through using the forward contracts. The last of the transactions that we have is a swap. Now, a swap of interest or principal in one currency for the same in another currency, which is basically trying to say that you're hedging against a currency, interest rate, or both currency and interest rate risk. When this helps in converting a high cost debt to a low cost debt. The pricing of the swap is generally the LIBOR plus the spread that is there. It could be plus or minus the spread depending on the circumstances. When you do a principal only swap, the exchange of principal in the two currencies happen, whereas the interest payments are fixed. The exchange of fixed interest payments are there. Covers the exchange rate risk because of the principal swap. Now, in the interest only swap, the exchange of interest cash flows is in one currency is there. There's fixed versus floating, and it covers the interest rate risk. In a full currency swap, where you do the principal and the interest rate swap, exchange of both principal and interest in two currencies are there. It covers both exchange rate risk and the interest rate risk. So by these products, the banking industry is able to provide optimized solutions to the banks, to the exporters, so that they can, as per the circumstances and the suitability, hedge and take advantage of the markets and take advantage. Thank you. I hope we could understand in depth what are the different products available by the bank to optimize the treasury of an exporter. In case of any further discussions, please reach us at jaya.maheshwari@myforexeye.com or at the given number below. Thank you.